We move to part B of the same question, that is question 2. We follow it keenly, word by word. It says, Triplecom Insurance Company Limited is a resident company carrying on both general and life assurance businesses. The following information relates to the insurance company's business for the year ended 31st December 2020. Triplecom Insurance Company Limited is a resident company carrying on both general and life assurance businesses. The following information relates to the insurance company's business for the year ended 31st December 2020. So we have two columns, that is general insurance and life assurance. So we have these items for each of those businesses. We have profit on sale of investments. We have premium received in the year, commission ceded, premium returned, recovery from reinsurance company, premiums paid to reinsurance company, commission expenses, management expenses, traveling expenses, marketing expenses, fees paid to investment managers, legal expenses relating to claims, general expenses, bad and doubtful debts, claims paid in the year, and bonus utilized in reduction of premiums. Additional information 1. Claims outstanding for general business were as follows. Claims outstanding for general business was as follows. Remember, claims are the major expenses under general insurance. So we are told claims outstanding for general business was as follows. 1. As at 1st January 2020, that is at the beginning of the year, 6.64 million shillings. That is claims outstanding at the beginning of the year. 2 is claims outstanding as at 31st December 2020 of 7 million shillings. That is outstanding claims at the end of the year for general insurance. So what we shall do is simple. We shall have to adjust the claims account as required so that we determine the allowable claims for the year 2020. 2. General expenses under general insurance include cost of computers of 800,000 shillings and cost of saloon car of 3.26 million shillings. General expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3.26 million shillings. Now, cost of computers is a capital expenditure which we shall disallow, but then we shall allow for capital allowance on computers. That is wear and tear allowance. Currently, wear and tear allowance on computers is at 25%. So we shall disallow the cost of 800,000, but then we shall allow for capital allowance of 25% of 800,000 shillings. Still on the same note, we have cost of saloon car of 3.2 million shillings. Now, again, this is a capital expenditure. We shall disallow the cost, but we shall allow for capital allowance. Now, this is saloon car. A saloon car is a non-commercial vehicle. Currently, qualifying cost for non-commercial vehicles for capital allowance purposes is restricted at 3 million shillings. So we shall do 25% of 3 million shillings. So we shall not use 3.26 million shillings because of that restriction. 3. Reserves for unexpired risk for general insurance was full. That is provision for unexpired insurance. As at 1st January 2020, 3.24 million. Then as at 31st December 2020, 6.2 million shillings. Remember, in taxation of insurance business, an increase in reserve or provision for an expired risk is treated as an allowable expense, while a decrease in the same is treated as a taxable income. So what we shall do is to adjust the reserve for an expired risk, and then we shall determine the taxable amount for the year or the allowable expense for the year. We shall do that as a working. Note 4. The life insurance fund balance was valued by an actuary at 310 million shillings as at 31st December 2020. 8% of this fund balance was recommended to be transferred for the benefit of the shareholders. At the beginning of the year, the fund had been valued at 250 million shillings. 10% of the surplus was recommended to be transferred for the benefit of shareholders. Now, this is now specifically on life insurance or life assurance business. Remember, the rule is where an insurance company does both general and life insurance businesses, then the two are treated as separate businesses. And so we shall determine the taxable income of each of these separately, then we put them together to get the total tax liability of the company for the year. So this is specifically touching on life assurance. So we shall talk about it more when we shall be determining the taxable income under life assurance business. 5. Outstanding premiums in respect of life insurance business was follows. Outstanding premiums. So as at January 1st January 2020, 12 million. As at 31st December 2020, 9.2 million. Again, this will help us determine the premiums for the year 2020 under life insurance business. And finally, note 6, other income received by Triplecom Insurance Company Limited comprise. This is what was actually received. And we know we receive interest income net of withholding tax. The withholding tax rate on interest income is 15%. So here we are told interest income received from fixed deposit account was 780,000 shillings, meaning this is at 85%. And it is a taxable income. What we shall do is to gross it so that we get the taxable amount, but under tax liability, we shall deduct the withholding taxes already paid. 2 is dividend received from qualifying company. Dividend received from qualifying company of 3 million shillings net, meaning the 3 million is after withholding tax has been deducted. And we are told it is dividend received from qualifying company. In other words, this dividend income was received by this company from another company in which it controls 12.5% or more of the voting power. So in that case, this will not be taxed again. 3, lastly, the company owns the building which houses its offices. Part of the office space is rented out to other tenants. In the year to 31st December 2020, the company received 2.8 million shillings net rental income from their estate agents. Property management fees amounting to 3.2 million shillings for the year to 31st December 2020 had not been deducted. Now this is allowable income under rental income, allowable expense under taxable rental income. So what we shall do, we shall have the amount received of 2.8 million shillings. Then we deduct the allowable property management fees of 3.2 million shillings. The difference will be a taxable rental income. So we shall do that and it's a computation. Required. The taxable income or loss for Triplecom Insurance Company Limited for the year ended 31st December 2020 for 12 marks. So one, I said, where an insurance company has both general and life assurance business, the two are treated separately and taxed separately. So what we do is simple in this case. We shall work out the taxable income under general insurance business. Then we also work out the taxable income under life assurance business. Then to get the tax liability, we multiply the computation tax rate by the sum of the two taxable incomes. Good. So let's start with general insurance. So that is question 2B. Question 2B. So we start with the general insurance. So here we have an income statement. Sorry, we don't have an income statement provided. So it means we can only use the gross profit approach. So we can do it like this. We say Triplecom Insurance Company Limited, taxable income computation for the year ended 31st December 2020. We can carry 3 zeros to use in our work. So what we start with is premiums. We start with the premiums. So we work out net premiums. So we have premiums received in the year. We say here premiums received in the year as 15 for 50,000. Then we adjust the premiums received with any items that are available. If you move downwards, we have what they are calling returned premium. That is premiums that were received by the insurance company from the insured, but given back, or rather returned back to the insured. So that means we deduct it. So we write here returned premiums. We have 374. We have what they are calling premiums paid to reinsurance company. That is still a reduction. Premiums paid to reinsurance company at 76.80. We deduct. Now, note 5 says outstanding premiums in respect of life insurance business was follows. Now that is for life, not general, so we can't use it here. If we had the same under general insurance, we would add the outstanding premiums at the end of the year and deduct the outstanding premiums at the beginning of the year. But the ones we have are for life assurance, so we don't bring them here. Any other items affecting premiums? We have the last item down there called bonus utilized in reduction of premiums. That is an addition. Bonus utilized in reduction of premiums. That is bonus that were to be paid to the insured, but then the company retained them for purposes of in exchange of premiums that were to be received from the insured. I'm looking for any other item affecting premiums. We do not have any. So we get the sum of all this very keenly. We have 15 for 50 less 374 less 76.80. Then we add 180. We have what we call net premiums. Net premiums of 75.76. That is net premiums. At that point, we say add other taxable incomes. That is, we add any other taxable income the firm had under general insurance. Add other taxable incomes. So we look for any other taxable income the company could have had under general insurance, then we add them at that point. Good. So we look at the list provided. If you are keen, there's what we call commission ceded. That is commission that was received by this insurance company from another insurance company for giving them insurance business. So that is a taxable income in the books of this company. We can have what we call commission ceded or commission paid. Now, if an insurance company A gives an insurance business to another insurance company B, the insurance company selling the insurance business receives a commission from the other insurance company. That is called commission on reinsurance ceded, which is a taxable income in the books of the receiving company. On the other hand, the company that is given insurance business pays a commission to the insurance company giving it insurance business. That commission would be an allowable expense. So in this case, we have commission ceded, which is a taxable income. So we write here commission ceded 8 million shillings. If you move downwards, we have under Note 3 says reserve for an expired risk for general insurance was followed. So we have the reserve at the beginning of the year and at the end of the year. What we do is to run this account. Then if it is a taxable income, meaning if it was a decrease, we tax the decrease. If it is an increase, we allow the increase as an expense. So that means we have to run working one. So we run a small working one. So I'm running reserve for an expired risk account. Reserve for an expired risk account. So balance brought down, we credit because it's a liability. So we say balance brought down, Note 3 that is, it is 3.24 million. Then we have balance carried down of 6.2 million shillings. We balance off the account. This is 6.2 million. 6.2 million. It means there was an increase which went to the income statement as an expense. So we should get that increase. So we shall do 6,200 minus 3240, 2960. So that 2960 will be an allowable expense. We don't bring it here as an income. 2, we have rental income. So in the in the list provided, we do not have a rental income stated, but we have Note 6. Note 6, the last bullet says, the company owns the building which houses its offices. Part of the office space is rented out to other tenants. In the year to 31st December 2020, the company received 2.8 million shillings net rental income from their estate agents, meaning the rental income received by the company from the estate agents was 2.8 million shillings. Then we are told property management fees amounting to 3.2 million shillings for the year ended 31st December 2020 had not been deducted. Now we know in taxation of rental income, property management fees is an allowable expense. So in this case, we are told the amount received as rental income from the agents was 2.8 million, but then this was before deducting property management fees of 3.2. Now if you look at that keenly, this firm realized a loss from this rental business because the amount received was 2.8 before deducting a management fee expense of 3.2, meaning there was a loss of 400,000 shillings. So that cannot come here. It will go under allowable expenses. Remember, one of the rules in taxation of insurance business is that the specified sources of income clause does not apply. What is that? Now, the specified sources of income clause states that where a taxpayer has two or more sources of income at the same time, a loss from one source of income cannot be deducted as against, or rather cannot be deducted from other incomes. But then that is not applicable in taxation of circles. In other words, in taxation of insurance companies. In other words, if an insurance company has two or more sources of income at the same time, like in this case, a loss from one source of income for such a company can be deducted as a loss, or as an expense against the income from other sources. So that will come as an expense later on. Still on note 6, we have what they are calling interest from fixed deposit account of 780,000 shillings. That is an investment income which is taxable on a circle or an insurance company. So we write here interest from fixed deposit account. Interest from fixed deposit account. And we are told this was amount received of 780. We only receive interest income net of withholding tax. So what we do is to gross the amount. So we do 100 over 85 times the amount given. The amount given as having been received is 780,000. So we shall have 100 over 85 times 780. It means the gross amount, the gross taxable amount is 917.65. The dividends are received from qualifying company, meaning the 3 million, which we are told is net, is not taxable again. So what we do is to leave it out of this computation, and the rule is if you don't make use of any item in your computation, you have to give an explanation under notes and assumptions. So you can say under notes and assumptions that dividends from qualifying company, i.e. 3 million shillings net, is not taxable beyond withholding tax, i.e. it is a qualifying dividend income. We look for any other taxable income under general insurance, and from the table given, from the list provided, we do not have any other taxable incomes. Yes, so we get total income. That is net premiums plus other taxable incomes. Let's do that together. We shall have 7576 plus 8,000 plus 917.65. I'm getting a total of 16,493.65. So we call that total income. Total income. The next step is to deduct the allowable expenses. So we say less allowable expenses. Remember, we are using the gross profit approach. So we bring in all the allowable expenses at this point. So we go through the additional information first. Note 1 says claims outstanding for general business was follows. Claims outstanding for general business was follows. So we have as at 1st January 2020 and as at 31st December 2020. So we work out claims. So we run a small working 2. We can do it here. Working 2, I'm running claims account. So outstanding claims are liabilities. So then the balance brought down is credited. So we write here, balance brought down 6640. Balance carried down is 7 million shillings. Then you look for any other items affecting the claims account. So back to the list provided, we have what they are calling claims paid in the year. Claims paid in the year of 9.8 million shillings. 9.8 million shillings. Claims paid. Now, if you withdraw money from your bank account to pay for an expense, you create a bank account as you debit the expense account. So here we say bank 9.8 million shillings. Any other item affecting claims? Any other expenses affecting claims? We look at the list provided. If you look at it keenly, we have what they are calling recovery from a reinsurance company. That is claims recovered from the insurance company, meaning the company paid these claims to the insured, but then part of this were recovered from the reinsurance company. So that should be credited. So we write here claims recovered. Claims recovered. An amount of 1.2 million shillings. So because that is the last item affecting claims, we balance off the claims account keenly. So we start with the debit side, that is 9,800 plus 7,000, a total of 16,800. We write that here, 16,800, 16,800, less 1,200, less 6640. We arrive at 8960 as the allowable claims for the year. So we write this income statement. That is the claims amount that should go to the income statement. So that is what we bring here from working 2. It is 8960. That is note 1. Note 2 says, general expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3.26 million shillings. Now these are capital expenditures which are disallowable, but we allow for capital allowance. So it means we have to work out the capital allowance allowable for the year. So that takes us to working 3. We write here capital allowance, working 3. We do that. So we consider in this case all the capital expenditures qualifying for capital allowance. Working 3, capital allowance. So 1, we have computers. Computers qualify for capital allowance currently at 25%. So we write here computers is equal to 25% of 800,000. That should be 200,000. 2, we have saloon car. A saloon car is an non-commercial vehicle. So then the qualifying cost is restricted at 3 million. So we shall do 25% of 3 million shillings. That should be 750, I think. Let's confirm. 25% of 3 million is 750,000. Any other capital expenditure incurred by the firm under general insurance? We have none. So we get the sum of this. We call it total capital allowance. That is 950,000 shillings. That is what we bring here, 950,000 shillings. Next allowable item. Now, just before we go to the other one, we are told general expenses under general insurance include cost of computers of 800,000 and cost of saloon car of 3260,000. Now, if you are keen, total general expense under general insurance is 8,490,000. But then we have only been given a breakdown of two. That is 800,000 and 3,260,000. That's a total of 4,060,000. Now, it means there is another general expense which is not yet accounted for. So then we have to work it out. So we shall have 8,490,000 minus the sum of the two in note 2. That is, the sum of the two is 800,000 plus 3260. That is 4,060,000. So we shall have 8,490 minus 4060. That is 4430. This 4430 has not yet been accounted for. It is upon us to assume whether it is allowable or disallowable. If we assume these other general expenses are allowable, we would bring it here as other allowable expense. But we have to write that note. If you assume it is not allowable, we do not bring it here, but still we have to give a note under that item. So assuming it is allowable, so you write under notes and assumptions that other general expenses are assumed to be allowable. Other general expenses are assumed to be allowable. So in that case, we bring it here. So we say other general expenses. We get 4430. 4430. And with that, we are done with general expenses. We move to note 4, note 5 are about life assurance, so we don't use them here. Note 6 is about other incomes, which you have dealt with. So under that, in that case, we have dealt with all the allowable expenses from the additional information. The next step is to go back to the list provided and look for any other allowable expenses under general insurance. So let's start from up there. So we have premiums received, commission ceded, premium returned, recovery from reinsurance, premiums paid to the insurance company. We have commission expenses. Commission expenses are allowable under general insurance, so we bring that here. Commission expenses. The figure is 1,050,000. 1,050,000. Next we have management expenses, still allowable under general insurance, so we bring that here. Management expenses. The figure is 2,034,000. Next we have traveling expenses, allowable, assuming the travels were for business purposes. So we have to write that under notes and assumptions for us to bring it here. So you can say under notes and assumptions that traveling expenses are assumed to have been for business purposes, hence allowable. And the amount is 1.2 million. You could also assume the other way. If you assume they were not for business purposes, we would not bring it here, but you would say under notes and assumptions that traveling expenses are assumed not to have been for business purposes, hence disallowable. Next, we have marketing expenses. Marketing expenses are allowable in business, so we bring that here. Marketing expenses. The amount is 314,000. Fees paid to investment managers, allowable. Fees paid to investment managers. The amount is 900. We have claims, legal claims relating to legal expenses relating to claims, allowable. Legal expenses relating to claims. The amount is 740. General expenses we have dealt with. Then we have bad and doubtful debts. Bad and doubtful debts are only allowable if they are specific. So here, we are not told whether these bad debts are specific or not. Again, for doubtful debts, or a provision for doubtful debts are only allowable if they are specific. So here, because it is just bad and doubtful debts, we could assume either way. So we can say that bad and doubtful debts are assumed to be for general bad debts and therefore disallowable. So that means we leave it out. Claims paid during the year, we have used to work out the claims in working 2. Then bonus utilized to reduce premiums are taxable incomes. We already have that here as 180,000. So it means in that case, this is the last allowable expense under general insurance. We get the sum of all the allowable expenses. So we add keenly. We have 8960. We have 950. We have 4430. We have 1050. We have 2034. We have 1200. We have 314. We have 900. And we have 740 finally. A total of 20 million 578. We deduct that from the total income of 16,493.65. The difference is 4,884,000.35. We double underline because it is the end of the working, and it is a loss. So we call this adjusted loss, or rather net loss. Net loss. So because it is a net loss, it cannot attract tax. Now we know that tax is imposed on incomes, and for a business firm, income is profit. So because in this particular case, under general insurance, the firm realizes a net loss, that would not attract a tax. So we shall say that in part 2, or rather, sorry, the question does not want us to look for to determine tax liability, but for illustration purposes, we can do it. That is under general insurance. Remember, the firm here has general insurance and life assurance. So we should move therefore to life insurance or life assurance business. Remember, the question is the taxable income or loss for Triple Com Insurance Company Limited for the year ended 31st December 2020. So we said under that, we work out the taxable income under general insurance, we work out the taxable income under life assurance, then you get the sum of the two. So this is just under general insurance. So we move to life assurance. So I rub this. So I move to life assurance. Now, taxation of life assurance, the determination of taxable income under life assurance is a 4-step computation which is done this way. One, we work out what we call, we compute the premiums receivable for the year. Premiums receivable for the year. So I will do it step by step so that we follow. So step 1, that is, step 1, compute premiums receivable for the year. Compute premiums receivable for the year. So I want us to be keen and do it together. Premiums receivable for the year. So if you look at the question, we have what they're calling premiums received in the year. Premiums received in the year. That is under life assurance of 100 million shillings. So we say received during the year. Received during the year is 100 million shillings. Then we come to note note 5. It says outstanding premiums in respect of life insurance business were as follows. 1, as at 1st January 2020 of 12 million, and as at 31st December 2020 of 9.2 million. So what we do is to add the outstanding premiums at the end of the year, and we deduct the outstanding premiums at the beginning of the year. So we say add outstanding premiums carried down, that is at the end of the year. Note 5, that is 9.2 million. Then we say less outstanding premiums brought down, that is 12 million shillings. So we get the net amount. We shall have 100 million plus 9,200 less 12 million. I'm getting 97,200 million. So that is what we call premiums receivable for the year. Premiums receivable for the year. That is step 1. Step 2 is to compute what we call maximum allowable management and commission expense. So I move to step 2. Maximum maximum allowable management and commission expense. So this is based on the premiums receivable during this. So we do this as per the Insurance Act. So you can continue and say compute maximum allowable management and commission expense as per Insurance Act as follows. So it's a step by step computation. So we say first 5 million shillings at 25%. So we get 25% of 5 million. 25% of 5 million. I'm getting it to be 1 million. 1,250,000. Then we say next 7.5 million. Next 7.5 million at 22.5%. We do that. So 22.5% of 7.5 million. I'm getting that to be 1687,500. 1687,500. Then we say next 7.5 million at 20%. 20% of 7.5 million is 1.5 million. Next we say next 10 million. 10 million at 17.5%. So we do 17.5% of 10 million. I'm getting 1,750,000. 750,000. Then the excess, that is the balance at 30%. So the balance at 15%. So we say balance. The balance now is this figure here less the sum of all this. That is 97,200 million minus the sum of all this. The sum of all this is 30 million. We can confirm. We have 5 million plus 7.5 million plus another 7.5 million plus 10 million. A total of 30 million. So we say 97.2 million minus 30 million at 15%. So we do that. 97.2 million minus 30 million. I'm getting 67.2 million. We multiply that by 15%. I'm getting 10,080,000. Then we get the sum of all this. We have 1250,000 plus 1687,500 plus 1.5 million plus 1.75 million plus 10,080,000. I'm getting a total of 267,500. 267,500. So this will be the maximum allowable management and commission expenses. Step 3 is to compute what we call determine excess management and commission expense. So I want to move to step 3. Allow me rub step 1 and 2 so that we do step 3 and 4. So I rub this. So I move to step 3, which is we compute excess management and commission expense. Excess management and commission expense. So this we do like this. We determine the management and commission expense reported by the company. Then we compare it with what we have just computed in step 2. So let's look at the list provided again. If you look at the list provided under life assurance, commission expense is 2,960,000, while management expense was 25 million shillings. So we do it like this. We say actual amount incurred. Actual amount incurred. We do it like 2,960,000, yes, plus 25 million. That will be a total of 27,960,000, 27.96 million. Then we say allowable. We compare it with the allowable. Allowable is what we have computed in step 2, and we got it to be 267.5. So the difference is what we call excess management and commission expense. So we do it. We have 27,960 less 16,267.5. That is 11,692,500. That is step 3. Step 4 is to compute what we call taxable income. So I do step 4. Step 4, compute taxable income. So we do that like this. One, we have we have to present it in the form of an income statement. So allow me rub this, then I prepare an income statement so that we work out the taxable income under life assurance. So allow me to rub this. So we are now in step 4, the last step. Compute taxable income. So the name of the company is TripleCom Insurance Company Limited. Taxable income computation for the year ended 31st December 2020. So we start with amount transferred to the life fund. That is at the end of the year. So we say amount transferred from life funds. That is as advised by the actuary. So we move to note 4 of the question. It says the life assurance fund balance was valued by an actuary at 310 million shillings as at 31st December 2020. 8% of this fund balance was recommended to be transferred for the benefit of shareholders. So that is what we used. It was the amount at the end of the year. So we shall do 8% of the fund balance at the end of the year, which we are told is 310 million shillings. So we work out that we shall have 8% of 310 million. I'm getting 24.8 million shillings. We write here 24.8 million. 2, we have what we call 30% of excess management and commission expense. 30% of excess management and commission expense. So we go back to step 3, where we computed the excess management and commission expense. If you are keen, we got it to be 11,692.5 million. So we do 30% of 11,692,500. You work it out. 30% of 11,692,500. I'm getting 3,507,075. That is 3,507,750 shillings. Then we get total, the sum of this, get total income. So total income in this case will be 24.8 million, that is 24,800, plus 3,547.75. I'm getting 28,307.75. And that becomes the taxable income under life assurance. Remember, the question is the taxable income or loss for Triple-Com Insurance Company Limited for the ended day. So what we do, we add this to whatever we got under general insurance. Therefore, total taxable income of the company, total taxable income will be the taxable income from life assurance, which we have as 28,307.75, plus the income from general insurance. But we realized a loss from that, so we say less, and it was 4,084,000.35. 4,084,000.35. So we work it out. We shall have 28,307.75 less 4,084.35. I'm getting 24,223,400. Now, if the question asked you for tax liability, we would simply multiply this total taxable income by the corporation tax rate given. But in our case, it has not been asked. But I hope you remember to do it. This is a company, so we use the prevailing corporation tax rate. That marks the end of question 2. It was testing you on taxation of insurance business, which is a subtopic under advanced aspects of taxation of business income. So revise that keenly. It is a must in the exam. If you are keen, you must do at least 2 questions from that particular topic. So both question 2A and question 2B were from the same topic, testing you on different subtopics. That marks the end of question 2. And in our next session, we shall be looking at question 3.